Hello, good afternoon to you all. Remember that today we're supposed to have a Zoom conference meeting where we're supposed to go through the value-based management. Well, since not everybody confirmed their availability, I've decided to record this lecture for all of us, then you can watch at your own time from the YouTube. So let's talk about value-based management. So we understand value-based management to be one of the models that is on your syllabus, and the idea of the model is to bring in financial and non-financial perspective, performance measurement, and also management. As we have said, financial performance alone is not adequate. Therefore, the syllabus includes some models which bring in non-financial or traditional financial performance measurement. So before we start going through our slides, I want just to give you an idea of this model. So the main idea behind this model is that financial performance measurement is not adequate. It has some weaknesses. One of the weaknesses is that it focuses on the historical performance of the organization, and also the possibility that financial performance measures such as profits may be influenced by the choice of accounting policy. So value-based management brings in a perspective which is forward-looking, which is not profit-based but cash flow-based. So that is a bit of the background to this model. So now let us get started. This model was examined in June 2014. If you look at part 4 of that question, it was question 1, it says explain how value-based management could be implemented at a company and evaluate its potential impact on the group. But just before that question on top is question 3, which asks candidates to evaluate the economic value added or to calculate the economic value added. So you'll notice that normally value-based management questions go together with economic value added or EVA computations. But the question in June 2018 to me is a much better question. It's much more comprehensive. And like I've always told you, some of the topics on this course can be learned much better by looking at the questions that the examiner has brought before. VBM is one of those concepts which can be better appreciated by looking at the questions that have come before. And this question, I feel, is much more comprehensive. So if you look at A there, evaluate whether the value-based management approach is appropriate for that company, Basel. A very good question because it will help you also identify features that you should look for before we can introduce the VBM approach. But B also very good. Explain to CEO what changes Basel would need to make to its performance measurement and management systems if we were to adopt a value-based management approach. Again, from this question, you can learn some of the impact, some of the changes that can be made to performance measurement system once you adopt the VBM approach. But C again was about a computation. You had to advise the company whether, or the CEO, whether the company had generated economic value for its shareholders. This was a computation. It involved calculating EVA. So as you can see, VBM questions normally go hand in hand with EVA computation. Now, let's move to what the concept is all about. So, what you notice that in value-based management, we try to align the organization's overall aspirations, what the organization intends to do in terms of its vision, its mission, and also we align its analytical techniques and even the management processes with something which is highlighted here. What is that? Key drivers of value. So what we are saying then is we need to identify our key drivers of value and try to align whatever we do with these value drivers. Here now we have some of the variables that you have come across before, which will further help us to understand the concept. What do we mean? Value-based management takes the idea of creating value through return on future cash flows. So if you notice there, value is created not by historical accounting profits, no, but by looking at the future cash flows. So this focus on future cash flows is embedded in the culture of the organization, the strategy, as well as its performance measures throughout the organization. Here we also come across some of the variables that you have dealt with in your basic financial management. What is that? Well, VBM starts with the philosophy that the value of the company is measured by discounted future cash flow. So that's how we value, that is how we estimate the value of the company. So the value of the company then is linked to the future cash flows. And if we discount those, then that can give us the value of the company. And may remember that in business valuations as well, this is one of the methods we use to value businesses, where we look at the future cash flows of the company, discount those, and what we get is the value of the company. Now, more importantly, when then do we say an organization has created value? Well, value is created only when companies invest at a return that exceeds the cost of capital. It's only when you have paid off, when you have generated enough to pay off all the providers of finance, the bondholders, the shareholders. If you're able to pay off that, if your return is able to cover all that, then you're saying that you have created value for your organization. So you notice the weighted average cost of capital concept coming into our discussion. So then, how is the concept implemented in the organization? How is it applied? How do we manage using the concept of value? VBM extends this idea of value creation to strategic and operating decisions. So strategic and operating decisions are guided by the concept of value, which involve, as we have seen, future cash flow generation, and also ensuring that we are covering our cost of capital. So VBM then should really align our strategic, operational, and managing processes to focus on what? To focus on shareholder value creation. So all the decisions that we make in the organization at all levels, our focus should be shareholder value creation. Now, this slide is important for us. Why? At the beginning of the course, we said that the objective or the idea behind performance management is to help organizations achieve their corporate objectives and goals. So then we need to know which ones are the core corporate objectives and goals which organizations should meet. And this is where now we make a point that VBM takes the shareholder wealth maximization as a primary corporate objective and seeks to align performance measures with this objective. So in value-based management, we are saying our focus is shareholders' wealth maximization. And the performance indicators that we have in organization primarily must demonstrate whether we have generated wealth for our shareholders. So what is the KPI then that the organization should have? The principal measure used at the strategic level is economic value added. And you may remember from divisional performance assessment, we covered the concept of economic value added, which we defined as net operating profit less the capital charge. So once we take our net operating profit, which we have adjusted to align it with the economic profit, We take out the cost of all capital, the cost of all the assets. Then what remains is what we call yield. And this value that you calculate is equivalent in the long term to discounted cash flow, which is widely used as a valuation method of shares. So then, if you take all the cash flows to be generated by the organization and you discount this, in the long run, the answer that you get, the value that you get really is equivalent to the economic value added. So what is the advantage of using economic value added for an organization? By using this sole measure, management is focused and they'll be able to avoid conflicts which occur when there are multiple measures and objectives. So companies, just like we have seen in questions, the two questions that have adopted value-based management, we expect them to use EVA. And EVA has an advantage. It gives management focus as opposed to having so many KPIs. EVA is adequate. Once an organization has a positive EVA, that's value created. Negative, value destroyed. The measure can be applied to decisions at all levels in the organization, strategic, tactical, and operation. Now, a number of times in this course, we have made a reference to these levels in the organization. That it is important that all these levels are aligned. We are making a similar statement here that in VBM, all the decisions at the three levels must be guided by economic value addition. So then, there's two terms here, value drivers and value mindset. These are the terms now that we're going to describe in the next part of our discussion. These terms are important. They're at the center of value-based management. Organizations that have adopted value-based management, we expect them to be very clear on what are value drivers, and we expect to see a value mindset.